Hi. Hi. Hello, everybody. Good morning, good afternoon, good evening, just based on where you are. I'm Alvinder Singh from the Monetary Authority of Singapore. But today we have two distinguished speakers as we continue this masterclass series, speaking on financial health and inclusion. We have Aiaze Mitha. He's the lead from the UNDP UNCDF Joint Digital Finance Program, as well as Mr. Jaspreet Singh. He's the global lead for financial health and innovation from the UNCDF. And they will be sharing with us a very fascinating topic again on financial health and inclusion, where we will learn to maximize the benefits of, say, the use of CBDC or any other instrument, while mitigating the risk. They will cover the design considerations as well. So now I hand the floor to Aiaze and Jaspreet, please.
Right. Thanks, Alvinder, for the introduction. And I'll just like to ask the host to share screen so I can. All right. Okay. Right. Good evening. Good morning. Where you're all joining from. I am Jaspreet Singh, and I'm joined by my colleague Aiaze Mitha, who has today agreed to run this masterclass for you. And just to give a context in terms of where we are coming from on this topic of financial inclusion and financial health. uh, you know as UN agencies, we have a specific mandate to see how we can further promote or push the economic development and the development agenda, and financial inclusion has been one of the core pillars of focus to achieve sustainable development goals over last couple of years. The way we are going to do this presentation is today, I'll take in for the first 15-20 minutes on where are we heading with inclusion and financial health agenda, why it is financial health becoming all the more important in our dialect and day-to-day conversations, and then Ayaz will help us unpack in terms of where could CBDC play a role in achieving that agenda of financial health or inclusion as we call it. But just to kind of give a broader context, we have been talking of inclusion for decade or so, and we have achieved great stead in terms of opening millions and billions of accounts over last decade. Payment infrastructure has proliferated across markets, to the last mile and to wherever we can take it to an extent. And we have seen how payments, has become such ubiquitous in terms of how it is being used in our day-to-day life. But the broader question, that has kind of still stood in front of us was that, how is financial inclusion or just by mere access to services is helping us, achieve the broader goal of impact or outcomes like resilience or security for the people that we serve. And I think that's where we are going to be talking today, in terms of not only why it is so important to look at the agenda of financial health, but what are the different use cases and why and how to kind of really look at it when you think of designing financial services, especially for the low and moderate income population, and how it is so important to keep some of the considerations in mind, in terms of how do they interact with finance and their behavior and social norms, and why they become so important in their day-to-day life and conversations. And that's where we're going to take this conversation to. So while I said earlier, that while inclusion has come a long way over last decade or so, we have certainly been able to create a foundational platform where digital has only accelerated the process. The question that still largely looms in front of us is, how is financial inclusion again creating that impact? And the way we stand today is that you know we have been able to deliver on our ability to create access and usage of services, with bank accounts, be it wallets, be it loans through banks or MFIs or fintech for that matter, even creating provisions like bundle products like insurance. But which one can say that a person is a financially included person. But we have also seen on the other side of the spectrum that that automatically does not translate into improving people's life. And it is much more important to think of financial services and technology in a way to how it can deliver on the other side of the spectrum, and not just trying to create a channel of access which provides basic services, but it doesn't kind of translate into anything meaningful for the customer. And this is where we really stand today, that while we have access to services, but people we see that do not have emergency savings. They're not able to save for their future. And possibly the pandemic is a very good, you know, has just showcased the vulnerability that we all live in today. Okay, that people during the lockdowns were so struggling to meet their ends meet, or were kind of struggling to kind of take their life forward with respect to, despite having access to bank account. Possibly it was good to deliver some social protection payments, but nothing beyond that. I think the conversation now has been moving towards how does financial health and well-being becomes a vision that we should all be looking towards, and not just focus on basic access to services. I'll give a case in point, in terms of why we are talking of this from a dimension of how financial inclusion, while it has been able to help us achieve the goals, but the moment we move beyond the standard metrics of bank accounts or number of loans and number of smartphone penetration, we see that there are deeper divides or issues that financial services is expected to tackle. And possibly that's where we need to really focus our effort on. And while technology can accelerate and it in things in many ways, but the larger question is it a magic bullet to really do it? And in what way, if the magic has to happen, in what combination should it be done, so that the magic really reflects on be able to address the needs of the population that we intend to serve. This map clearly demonstrates one example of that. And I've picked up markets which are known for their technological advancement as well as good degree of financial inclusion. You would have often heard of the numbers like in US, 40% of people are not able to come up with $400 of emergency savings if they have to. And there are a lot of lower middle income households have to resort to payday lenders and get loans from them to be able to make their ends meet. you know Going to Kenya, which has been the poster country for a good payments effort that has been made over last decade or so, we see a small part of credit issue looming out, blooming in over there, with all aspects of technology reaching the last mile. And we still see how people are struggling to getting into this crisis of how they're interacting with money overall. So the idea is not to kind of really present the gloomy picture of has financial inclusion efforts really paid off on the right things. Possibly it has, because it has actually helped to establish the infrastructure, the last mile connectivity, possibly help us build the use cases. But to a large extent, financial inclusion objectives have been very much focused on helping the payments ecosystem grow and build. I think what is kind of important is to start thinking of how we take inclusion plus approach, which is beyond payments, and which where the products and services that we deliver would be much more meaningful to the population that we serve. And I think that's where we talk about today, as well, with the three examples that we will look into, with informal workers, which is gig economy workers, the women, and the migrants. A very big chunk of population that we intend to serve over a period of time. This map again just reflects how the resilience across the world currently stands. This is based on the Findex data, where we have just been trying to understand that people will be able to come up with 1/20th of their GNI per capita, as savings or not. And you will see clearly that there is a marked difference in terms of which parts of the world there is at least some degree of resilience versus no resilience or lesser resilience compared to that. And this is like just one single indicator moving beyond excessive usage. What we are saying ultimately is that while financial inclusion has been able to build that basic foundation, but now as we think of moving towards financial health, we need to be asking ourselves this question: what does a financial product or a service unlock? And I think this will become more important as we think or talk of today's conversation on CBDC. We are talking of creating a layer of new technological advancement, the way digital currencies we interact with the people, but ultimately it is the individual or the person on the ground. Think of that last mile, who has to interact with it. In what ways he or she is going to use it, how they will perceive this to be, right? And it's important to start thinking of that. Not only what are the financial product or service unlock, but what does it take to use it or make it in a way that it helps you to be financially secure and free. One should be asking this question: is my innovation or service transforming the financial lives of individual, household, and community, and in what ways? Are we just kind of investing ourselves in the process of doing technological advancement, which might create some good tools and you know uh, technology for that matter, innovation for that matter, but how useful is that going to be for the person who's going to ultimately use it? And I think that's where this larger question of innovations really stick in, that when we think of financial innovation, we need to be looking at from the perspective of the consumer who we intend to serve. I'll talk of three case studies in particular, and how they have been trying to address the needs of these individual segments. And maybe when we talk during Aya's session on CBDCs and its role with achieving financial health, we'll be able to unpack a little more in terms of possibly what are the challenge or gap areas that we could really think through as we progress on this journey, but also how this journey could be made much more effective and efficient to serve the last and the low income population in particular, who might not have even access to a smartphone but might be dealing with a basic phone at its disposal. We have to kind of think it from all that lens to really make the technology work for everyone and not just one particular segment of population. I want to start with this one segment of informal workers, which has particularly been very interesting because while platform economy has grown over a period of time, we have seen how new models of platform or marketplaces have created jobs, and how informal gig economy workers are interacting and using them to create their livelihood. But at the same time, what we've also been able to find is, during various research and surveys beyond UNCDF's own work, that how during how these people live on a very volatile income, right? Where their savings, their financials are very stretched on a day-to-day basis, right? How they so much depend on government assistance, or in absence of social protection, they don't have a fallback mechanisms to be able to take care of their short-term or long-term needs. Ultimately, the idea of finance or finance in any form is to help serve these people for a better life and help them create resilience and financial security, which will allow them to take care of their lives on an ongoing basis without getting too affected by the vulnerabilities that they all face. And COVID-19 was just a you know just the right time to basically see what are the areas where these people have been facing shocks. And and despite the fact that these markets from where the study also originates, they have been financially included strongly, good smartphone penetration, good technological advancement, but we still see day-to-day struggles of the people, and how they interact with finance, what kind of trust do they have as you kind of go into the rural areas with respect to how people are going to be using financial services in one way or the other. I want to present this example from Safe BODA, which is basically a platform, a ride-sharing platform working across Uganda and Kenya, Kenyan market. And basically, as a ride-sharing platform, they were pretty contented with what they were doing on the side of just getting people transported from point A to point B. But what they were able to kind of also found that while they were kind of transporting people from point A to point B, that was sufficiently not enough for consumers. And how what they kind of went about doing was that they started looking at the idea of exploring how the platform or market, the platform itself could expand into becoming a marketplace which can create a offering of product or services which especially get definitely utilized for by the gig workers or informal vendors. They basically went about targeting them, obviously riding on the data that they were generating in the entire process. But the larger question for them loomed over, that how they can translate that data into creating meaningful services or products around savings and credit, which could help the gig economy workers that were interacting with them, or the informal SME vendors for whom they were doing the delivery, be better off from where they are. And they went about using or deploying the data to understand consumer behavior, to be able to create products or generate products which could be delivered to them in the right way, but for in a more responsible manner. The point I want to just kind of highlight over here is that it is important to think of technology or innovation from the context of the consumer that we are serving. And how does that basically blend in with the use case that we are trying to deliver on. And it is important to understand that, because then the real utility of the technology comes into play. And this was just one example of how Save BODA is going about working on addressing the needs of their gig workers and the SME vendors attached to them in a very prominent manner, using innovation and data in the right combination. And in the interest of time, we'll just run it as well quickly. The second segment I wanted to touch upon was women, which have, despite all the progress on the inclusion side, we still see a large gap, a gender gap, especially in terms of women's access to financial services at the very least, where we see 33% gap between the male and female in terms of, how the account holdings take place right now. And obviously, women are kind of constrained by many social norms in their environment. And as you think of markets like Asia and Africa, and when we're designing for any technological innovations, we're not only talking from the perspective of only developed markets, we're also thinking of developing all the least developed countries, where some of the other barriers or challenges are very prominent when you are trying to serve the different segments who are more likely to be benefited with financial services if they have access to it, but who can kind of go a long way in empowering their life if the services or products are offered in a way where it can be really of great utility to them. And in this particular case in Nepal, what we saw with this one fintech, Alloy, which is actually working on helping women connect with credit in using tokenization method, where they have been able to create this entire ecosystem with women enterprises and women entrepreneurs who interested to basically build their livelihood on starting agriculture or new enterprises. And this organization has gone about setting up an ecosystem of vendors within the geographical limits of where they serve, and has helped women in terms of not only receive credit from bankers, but ensuring that the credit is actually used and the end use of credit is actually wanted in the right way. This is a very big challenge, at least in market like Nepal where they serve, that bankers are very often, in often cases, are not very comfortable lending out to low income segments, especially in rural areas, because of lack of history or lack of collateral in these geographies. And what this provider is able to do is basically unlock that process of taking credit to the last mile to the woman, and be able to bring that comfort back to the bank or financial institutions in terms of how they can basically make it work by tokenizing the entire value chain or the ecosystem in the neighborhood where this is basically being offered. Uh, Moving to the third segment, possibly in a little quicker manner, with migrants, where possibly we keep on talking of how big this is a segment, the remittance itself, and we have seen how uh, migrants basically does their remittance from Hawala system to formal system to multiple other channels that they use. But one thing that we have been able to also understand is that some of these things do not work in isolation at times, right? A migrant might be sending out the money back home, but this is an interesting case, from Nepal, I will take again, where a migrant has to, take loan when they have to go outside of their origin country to the destination country to go and work into a new place. And then when the remittance comes in, they actually are, often using that money to pay off the loan, which might be taken in a very higher interest rate model to begin with. And this organization in particular, and basically New Street Tech, what they're trying to do is they're looking at how do you finance against remittances, where basically you take in that future remittance flow going into the market as a way to create the guarantee for the financial institution to come in the beginning and lend out at a lower interest rate. So compared to a money lender who might be giving out loan in the early days for this migrant to move out, which might be at something like 40 to 50%. Banks can really, come in at the time to basically offer the loan and use the remittance flow to really help capture value, but at the same time be able to create that differential for the household, which might be spending a lot of money in the beginning of its remittance flow just to pay off interest. So it is important to understand how these contexts vary and work together in order to make these services or products or even technology more relevant within the context of these services. The purpose of really sharing these 2 or 3 use cases which are currently in play with these 3 segments was just to make the point that when we think of technology or financial services, it is important to think it in context of the consumer that we are serving ultimately, and where what kind of use case and how is that in that local market is going to affect. So when we think of moving towards this journey of CBDC and how it could basically help us create a new level of technological innovation, it will be important to not forget in the process that how is this innovation really going to serve the last mile or the customer who you usually used to call unbanked or underbanked, but who might be low income or moderate income, and might not be willing to interact with technology in the way and shape and form that maybe some of the urban income customers might do. So I just wanted to put the stop over here and hand over the floor to Aiaze for taking and talking more about the connection between financial health and CBDC. Aiaze, over to you.
Thank you very much, Jaspreet, and I'll try to be as efficient with time as you have been. So next slide, please. Just as an introduction, this is not a masterclass about CBDCs. This is really to talk about how CBDCs might connect to some of the agenda that Jaspreet, you have been mentioning in terms of serving the last mile, in terms of serving all these different segments that you have mentioned, including migrant workers, and how CBDCs could actually be harnessed effectively through design choices at the service of these different segments, and not just financial inclusion, but financial health. But just perhaps by way of clarification and by way of introduction, because there's many definitions circulating about CBDCs, what I'm going to be talking about here is really CBDCs, specifically not digital currencies, but CBDCs as a new payment instrument that is essentially denominated in national unit of account. So it's really the equivalent of a physical banknote in a digital format. It's not a digital representation of money that sits somewhere else, like in the case of the credit system or in the case of mobile money accounts. This is really sort of the equivalent one-on-one of a physical banknote in a sense, in its digital representation. Of course, there's multiple design aspects when one thinks about CBDC, and I'm sure there are CBDC experts on the call here. We talk about retail CBDCs, wholesale CBDCs. We talk about different ways of central bank relationship with CBDCs in terms of direct CBDCs, where central banks actually manage directly the retail accounts and retail balances, or hybrid CBDCs, where central bank use distributors, but they manage direct retail accounts, to actually indirect ones where central banks manage wholesale accounts. But I'm not going to talk about all these design elements. I just want to talk about the ones that might be relevant to our discussions here. Of course, most developments are still early stage, and we still have sort of a limited understanding of all of the potential impacts and effects and macroeconomic impacts in particular of CBDCs. But if we go to the next slide, just to see what's the current status in terms of level of development, we know that most countries, a lot of the central banks that were actually interviewed by the BIS have declared to be interested in CBDCs. Many are in the R&D phase, some are in the development phase, some are actually in the piloting phase. We've all heard about the Chinese digital yuan called DCEP piloting. And we know that some are live. We have in the Caribbean, in fact, in the Bahamas, the Sand Dollar that's gone live in 2020. We have in Eastern Caribbean, the Dcash CBDC that's live now since a few months. And we have others coming out very soon. So this is sort of still in early stages, I would say, of development and experimentation, but it's really interesting. And so if we look at the potential benefits on the next slide, please, Jaspreet. And this is sort of what connects to your discussion a bit before. There's this understanding that CBDCs drive significant potential for financial inclusion. And they could drive significant potential for financial inclusion because of the universality. It's issued by a central bank and it's aimed for the entire population, because of security features that bring the sense of trust and confidence into the platform. through encryption and other mechanisms. And of course, affordability, because the cost of moving around money on a CBDC platform would pretty much be the same cost as the cost of moving cash around. So unlike mobile money providers that charge you a certain fee as a percentage of the value being transferred, on a CBDC platform, most likely you would be able to make payments like you make payments in cash with no fees attached, or at least that's what's sort of expected. And of course, for that potential to materialize, there will be different prerequisites. There's, of course, access to infrastructure. That means digital connectivity, smartphones, electricity, which in some developing countries is still a bit problematic. You would need to have broad distribution of CBDCs, and that sort of relates to the design conversation I wanted to have a little bit in terms of how this gets into the hands of the people that it's intended to serve and to benefit. Of course, it requires incentives for adoption. It will require some sort of financial digital literacy and education programs, because obviously this is a whole new technology that's very complex, and interacting with it might not be as easy and as straightforward as one would hope for. And of course, it will require a lot of mechanisms for oversight. So I would say financial inclusion is probably one of the key areas where there's a potential promise. And I'll talk about some of the design elements that might be affecting the realization of that promise to a certain extent. So really focusing on those design elements. The second area is really in terms of international remittances, both for people and for businesses, in terms of sort of regional trade. And I think remittances are really an interesting topic, because if you look at the cost right now of international remittances, on average, it's about 6.5% globally of the amount being transferred that's charged as a fee, as a cost. And that 6.5% is a global average. But if you look at sub-Saharan Africa, for instance, it's about 9% of the money that's being charged for any amount that's being transferred from a developed market into a developing economy. And the banks in general, globally, as a global average, have been charging 10%. So this is a significant amount that gets wasted in international remittances. And one of the reasons why is that you have so many intermediaries in the traditional financial system. You have a lot of intermediaries, which means everybody has to be able to remunerate themselves for the services that they render. And the payment messages go across multiple hops before actually an entire end-to-end payment is settled. And that, of course, includes time zone differences and all sorts of other problems that create additional complexity and delays in addition to cost. In the case of CBDCs, you would have less intermediaries, you would have instant processing, atomic settlement, which ensures basically that currency moves in one direction, particularly in the case of trade, when the equivalent amount in the other currency moves in the other opposite direction. So that sort of gives a lot of security and trust into the transaction. And there's potentially no liquidity needs at the other end if there's agreements between governments to have either interoperability of CBDCs or currency swap agreements. And in that case, you wouldn't need to manage liquidity at the receiving end, which is one of the biggest problems and challenges also in terms of the cost structure of existing remittances. Of course, that would require some prerequisites in terms of interoperability, as I mentioned, currency swap agreements. There's an interesting project which is called the MCBDC, which is actually a multiple CBDC bridge, if you would like, that is currently being piloted between China, Thailand, Hong Kong Monetary Authority, and the UAE. And that's sort of a first development towards having almost like a CBDC switch on a global level, if you would like, to enable CBDC exchanges, which would facilitate those international transactions quite a lot. The third area of opportunity is really around traceability and control, because those transactions now are visible, they're traceable. That allows central banks to have much more effective monetary policy because they know where the money is going, they can track the payment transactions, they can actually manage money supply much more effectively. And that also supports all the domestic recovery efforts and G2P payment programs in effective ways. But also the fact that money is now traceable in a particular country could also strengthen or reinforce international trust in that country, and that would strengthen potentially foreign direct investments or sustainability related investments from foreign countries into that particular market. And so that's sort of another area. And of course, there's potential risks, and the risks related to CBDCs could be around disintermediation of existing financial institutions if central banks are issuing currencies directly to retail customers, for instance, or retail individuals. So there could be potentially a disintermediation effect that needs to be understood and that needs to be taken care of in a sense. And we'll talk about some design elements associated to that could drive to financial instability to a certain extent. It can actually also impact competition. You were mentioning, Jaspreet, a bit before, that data is key to actually starting to offer access to much more refined and much more sophisticated financial products and services. If all the data now is accessible only through CBDCs and mostly through CBDCs to central banks, how is that data going to be shared? Is it going to be shared just with financial sector, with the entire market? Does it cause issues of competition between different players and providers in their ability to harness that data to offer more sophisticated services? These are all sorts of questions that need to be addressed. And of course, there's questions around currency substitution as well. If CBDCs start being exchanged internationally, which means really in a digital form, currencies of different markets can be exchanged internationally. That means people from a market with very high inflation or currency volatility might be tempted to actually move their money out into a more stable CBDC in a sense. What does that mean in terms of monetary policies, in terms of your control of money supply in a particular market when there's a huge movement of money towards other foreign CBDCs? What does that mean for the banking sector? All these are sort of major issues, obviously, that we are just starting to grapple with. But if we move to the next slide, I just want to talk about a few of the design elements now related to those opportunities that I mentioned and some of these questions and challenges that I mentioned. And I'm sorry if I'm going sort of a bit quickly through this, but I just want to sort of give people a flavor for some of these issues and topics. We don't have the material time to go into all the details, but I also want to have an opportunity to engage with you, Jaspreet, on some aspects of opportunities that you mentioned. I think in terms of the design considerations, the ones that I feel are really important are related to inclusion by design. How do we actually drive inclusion by design around the CBDC platform? The distribution piece, the privacy, I'm not going to talk too much about it, but I'll just briefly touch on it as we discuss inclusion, and then the programmability of money, which are, I think, the three characteristics that are really interesting in terms of design. So let me move to inclusion on the next slide, please. On the inclusion front, I think there's many decisions for someone who's actually working on a CBDC project to look at. First of all, is it going to be token-based or account-based? Account-based means you're identifying an account through the identification of the account owner, which means there has to be a very strong ID verification system in place, versus token-based means you're just identifying a user based on the fact that he knows the private encryption key or the security key to be able to use that account, which is much more flexible, but also offers less protection to consumers in case they don't know how to engage with that, or in case they lose the security key or the private key. How do they then interact with their wallet, in a sense? So there's trade-offs here in terms of infrastructure you need, in terms of the level of autonomy and control you give to users, but also the complexity. The token-based is much more empowering in that it gives the user much more control through the ownership of their private key, but then it's also more risky for the user in a sense if they lose it. Is it custodial, non-custodial? What are the kind of payment methods you're going to be offering, particularly in developing economies with less infrastructure? Do you actually allow for offline payments? Do you make it easy for people to use CBDCs to make payments through barcode scanning and QR code scanning? Do you have a tap and go functionality? Do you allow two people offline to tap their phones together and be able to exchange money? So you could almost do it even with basic phones without having access to smartphones and to the internet. All these design elements actually could drive inclusion or could reinforce exclusion in a sense. So they're really important to consider. Are you introducing tiered KYC levels with some level of anonymity for the lowest level of KYC? So you could have sort of a CBDC wallet that's just anonymous and linked to a cell phone number at the lowest level of KYC. And then if you want to make more transactions, you need to upgrade to a full KYC kind of regime or setup. So that's sort of the kind of design elements that would be needed to actually look at being more inclusive in a sense. And then, of course, you can also introduce transaction size limits, account size limits, etc. Also, again, with the perspective of allowing sort of lower KYC users to come in and start transacting potentially anonymously. So these are all mechanisms that could be really interesting. The chart, I'm not going to go through this in detail, but I guess we can distribute the slides. It's just a model of the e-krona in Sweden and how it's actually been designed in terms of the way it operates and the way it actually delivers CBDCs to end users through the network of existing players in the market. If we go to the next slide, which is now about distribution, and that refers to the notion of, on the one hand, market stability by not disintermediating existing market players, but it also points to another issue, which is the issue of inclusion. If you want inclusion, in addition to what we just discussed before, you also need to drive access. And access is sometimes best achieved by actually distributing through existing intermediaries and acceptance networks. So if you look at the example of China, for instance, the way they're actually designing their current digital yuan to be distributed is through the entire existing financial system. They're going to use the banks, they're going to use China UnionPay, they are going to potentially use Tencent and with WeChat Pay and Alipay from Ant Group. All of these existing platforms, because that allows them to really reach very deep to existing users of these digital wallets. And it also allows them to actually harness the existing acceptance network of all of these players. So it's China UnionPay has millions of merchants around the world that actually accept their payments. Those merchants would now be accepting payments in CBDCs. So there's really value in trying to use the existing distribution network to the maximum of its potential, not just for distribution, but also for acceptance. And then if you go to the next slide, which is sort of the final point I wanted to make here, is the programmability aspect. And the programmability aspect is extremely relevant because in many different ways, that will be allowing central banks to start really driving monetary and fiscal policies through CBDCs. You can start distributing inactive currency to a financial institution, and that currency only becomes active when they start complying with certain good interest rate practices, for instance, that you want to enforce as a central bank with the view of protecting users. You could start distributing general purpose CBDCs, which means people can just use that currency for anything versus programmed use. For instance, food coupons. So if you want the CBDC in the context of a conditional cash transfer or a G2P payment to only be able to be used in a particular acceptance network for a particular type of purpose, or for paying school fees, or for paying for certain goods and services, you could actually program that into the currency so that when people receive that digital currency in their account, they can only start using for that particular purpose. You can also decide that you want to tax transactions in a differentiated way. And tax transactions that are going to be more sustainable in terms of consumption behaviors, a bit less, and tax sort of carbon intensive transactions a bit more. And so, you know, you can start really applying those differentiated financial, fiscal and monetary policies to currency, which today is not doable on physical cash. And so that opens up a whole range of opportunities. And of course, there's machine-to-machine payments that can be now automated in many different ways through smart contracts and CBDCs that really allow machines to interact among themselves in a sense. So my TV could start renewing my Netflix subscription without me having to interfere with anything, and that happens on a regular basis, and it's done between the machines directly. And so there's a whole range of other opportunities that rely on that programmability aspect, which is an important design element that could also really drive more efficiency, more automation, but also development outcomes and inclusion and financial health outcomes in many different ways. So I'll just pause here for a second. Maybe we can just put the next slide on screen. I'm not going to talk to it, but that's sort of really building on what I just described in terms of some of the key features and some of the key design elements, how CBDCs can actually contribute to financial health and different aspects of financial health, from resilience, security to freedom and control. And perhaps that's sort of the perfect time to turn it back to you, Jaspreet, to have sort of hear your reactions to this. I know you're a champion of financial health. And I guess I hope that through sort of this very quick discussion of some of the design elements, I was able to at least point to some opportunities that might materialize in using CBDCs for financial inclusion and financial health. And I just wanted to sort of hear from you, what your first reaction is to this potential and some of the concerns you might have. And you're on mute, Jaspreet.
Yes, the challenge with the technology sometimes. You forget about small things. But yeah, thanks so much for the quick overview on what are different use cases, or how at least CBDC in different contexts from a design element, from a programmability element has to be looked into. When we talk of financial health in general, and especially as we think of how payments have obviously pulled everything in a direction that people have access to services. Payment has become so, we've always been so used to payments in a way, right? When we think of financial health broadly, and especially I like to talk about rural and low income customers in particular over here, and we'll be keen to at least understand that yes, there are a lot of technology design elements that it seems to be played out over here. But what we've seen in rural areas, or especially with the low income customers, when they interact with technology, this can be a simple wallet based payments. Trust is a very important factor, okay, which is like at the very core and heart of how their idea of money is, right? In terms of, can I really trust the technology for safekeeping of my money? We've seen how large government programs on social protection have pushed millions of accounts to be opened up, and those accounts receive billions of dollars of funds every year. But how basically people take out the money in cash and then put it into a in their house or maybe some other bank account, right? So how I think the trust element is very important. So my first rather question will go back to you in terms of how will CBDC and what is really required to be done in order to create the element of trust, which is actually will help this low and the rural population to basically get this experience, and not just being pushed from a top down agenda, where the adoption becomes very difficult to have. How do you think that could be overcome, possibly from the aspect of design or programmability that you spoke of?
So yeah, I mean, thanks, Jaspreet. So obviously, trust has multiple dimensions. And first of all, a CBDC is a digital representation of physical cash, as I mentioned. And that means you have direct claim over the central bank for that money. There's a direct liability of the central bank for the money that you hold. If you hold money into a bank account or a mobile money provider or with a bank, if that bank goes belly up, you're only protected to the level that the deposit insurance is actually protecting you. And there will be some cap to how much money you can recover from that bank, unless the government puts in place something specific. Now, this is really about the central bank having direct liability to each individual owner of CBDC on that value. That value is something that you shouldn't be losing. So I guess saying this means there's going to be as much trust as you have trust in your central bank and in your government. If your government has already defaulted you in many ways, or your central bank has defaulted you in many ways, that's going to be a problem. So first of all, your trust is sort of at the level of trust you have in that institution. From a technical perspective, there's a lot of discussions around sort of reliability of blockchain and distributed ledger technologies and scalability of these technologies. A CBDC doesn't have to be built on a DLT or on a blockchain. It could be built on more standard technologies, if you would like. There's different types of architecture. For instance, the Chinese digital yuan is not built on a blockchain platform. There's elements of it, but really the concept is not built, is not a typical sort of distributed ledger concept. And so in that case, the technology trust shouldn't be so much of a problem. I would say it's more the institutional trust that's sort of really key here. And the one guarantee you have is that central bank money directly issued to you by the central bank, and you have a claim over the central bank. And that should be reinforcing trust in a sense.
How much of this will become a problem from a financial education or financial capability point of view? Able to enforce the idea of adopting digital currency in the way we are speaking of?
It is. So there's first, we've all been adopting in many ways digital payments, even including, in most of the markets in which you and I work, we see mobile money, mobile payments, etc. People have started adopting them because of the benefits, in a sense, and it's taken time. So I guess the usability of the interface and the easiness of interacting with it, the easiness of having access to it, is going to be something really important, which is when I was saying that, it's being distributed through existing providers. And if through your existing digital wallet or mobile wallet accounts, you're able to access it, that will first facilitate sort of interaction with it. But I guess one of the big incentives is going to be the fee structure, in a sense, because right now, all of the commercial providers are going to charge you certain fees for transacting on a mobile payment platform or on other platforms. You're going to be paying a commission as a percentage of the amount being transferred. This is like moving cash around. The government is not going to be charging you money for it, or at least it is anticipated that they won't be charging you money. Of course, they will be using that for monetary policy transmission. So at some point, there could be negative interest rates. There could be all sorts of interesting things coming up. But essentially, for the money transfer aspect of it, you will not be charged. So I guess for very cost-sensitive segments, that will be an interesting incentive to get them to adopt it.
One more point I want to maybe put to you, Aiaze, that we have often seen that despite this push of taking money to low-income households and population, how much of there's a dependency on agents and business correspondent models, which basically act as an intermediation layer. Because financial institutions themselves do not have a brick and mortar structure across all places. And we have seen that rural households, especially or low income households, very much depend on these physical outlets for a lot of their interaction and transaction, and be able to put the money in from even to do a remittance, a simple remittances, right? Where do you see the so, and we often call it digital in many ways, but where do you see this evolving out? If something like CBDC has to really come in.
So you're really picking on all the right issues and all the right pain points, Jaspreet. I guess that's sort of that will remain a challenge, obviously, as long as you don't have a sufficient acceptance network for making payments in CBDCs. But that could be facilitated in many different ways. So if you look at the Chinese experience, for instance, what's been piloted is that even with basic phones, you can actually just tap each other's phone. Well, basic phones with some capability, of course, but you can almost just tap each other's phone to transfer value between two wallets, in a sense. If you make it that simple and that easy, and if you are able to get the acceptance network in place and you can enable offline transactions, that would pretty much allow everybody to interact with it. And so the question is, to what extent are you able to put that infrastructure in place? And I think the government probably has an advantage to be able to harness all of the existing infrastructure. There's a lot of closed loop systems, as we know. If you look at just at mobile money in Africa, there's a lot of closed loop systems in place. That's the model. The government can actually run through all of these to aggregate all of the acceptance networks of everyone and allow you to make a transaction in CBDC across every single platform and every single merchant and every single small business, in a sense, and make it so easy that it would be kind of almost, I don't want to say nonsensical, but it would be sort of convenient for you to make that transaction using your phone. Now, that takes some time, obviously, before all of that is in place and all of this acceptance network is operationalized and people are educated. I'm sure one of the key challenges that you are seeing in many different ways is always related to financial and digital literacy, obviously, and you're probably seeing it already in your existing context, right?
But I think, a lot of, this is around behaviors as well. And when we talk of financial health broadly, Aiaze, we basically are trying to address the behavioral issue and, how people behavior around using money or money management really lies. It's kind of all around that. So, when you took example of China and, how they have been experimenting into this, we should not forget that, there's a baseline that's already established in China. How over last couple of years, people have been so used to using paying in digital form, right? So they've been very used to that entire idea of how digital can play that role in their lives, and how payments and money can move. Now, when you start thinking of markets which are still very much early in their journeys, right? Even let's take places where financial inclusion might have been achieved in many ways, but there the adoption is still very much early in many
Yeah.
big ways, right? So how do you see them leapfrogging with CBDC? And is it only for the markets which have not only achieved such certain level or degree of sophistication with financial services and technology, and where people behavior is already is getting reflected in the way they transact and play with money, or do you think this is also going to be relevant for markets which is like in large majority, where some of these things might not even exist in that way?
Yeah, so I feel like the answer is almost embedded in the question, right? Because there has to be some level of maturity and existing practices established, and particularly because, as we discussed earlier, the distribution of CBDCs is going to be extremely important. How you distribute that, and there's a lot of questions around how you distribute that and which kind of market players are going to be harnessing, and obviously in markets that are much less mature in terms of the financial market infrastructure. Distribution becomes a challenge. And in those markets, most likely fintech providers and fintech platforms are more relevant in a sense to distribute that to the end users. And that might actually tip the balance to the advantage of fintech providers against the financial sector. But in markets where you don't have any of that, really unsophisticated, underdeveloped market, that could become a major challenge. So it would require, in my view, and you're totally right in making that point, a certain level of maturity of infrastructure, at least digital connectivity, access to phones, access to energy, etc., and some level of comfort with using digital payments and mobile payments for that transition to actually be more natural in a sense. I don't think I always love to dream about leapfrogging, sort of starting from nowhere and finding yourself as a leader. In that particular case, I think it's really complex. And so the other problem, Jaspreet, is not just on the user side and the infrastructure side, is also how prepared are central banks to deal with the topic. As I just mentioned, there's a lot of very complex questions around it. It also requires central banks to be mature enough in their operations and their skills and capabilities to advance that.
And possibly, to also kind of complement that with the consumer protection aspect of all of this. Because we're also seeing, how that is still a concern or area of work, for most of the central banks across the world. And when we are basically, pushing something like this, that takes it to another level altogether in terms of, why it needs to be the thing that has to be urgently put in place in the mechanism and system. So I think those will be kind of questions, which come alongside with it.
Yeah, of course. And that's sort of, and the consumer protection actually links to some of the questions that I see have been asked in the chat as well. It's, stable coins would work very well. I mean, they would be able to do pretty much what a CBDC does in many different ways, except that with a CBDC, first you have the guarantee of the central bank. You have a potential mechanism for moving money across currencies fairly easily, as opposed to relying on sort of one single currency platform, and that's managed by a private sector player. And we know some of the issues there are currently with some of these stable coins from a regulatory and some AML CFT perspective. So that could become a problem. And the other thing is, in terms of the cost, once governments agree or CBDCs become interoperable, you could really instantly and at no cost move money between currencies, which in many different ways in the international remittance space makes a huge difference. I mean, some countries have huge reliance on international remittances. Sometimes in some of the Pacifics, in some of the Pacific islands, it could actually represent as high as 30% of GDP. In that context, when you move from a 6% fee or 8% fee to a 0% fee, that makes a huge difference.
Right. I still have one or two questions for you on the chat, and I'll just put it for you.
And when do I get to ask my questions to you?
Yeah, I think we are running out of time. It seems, we just have like 2-3 minutes to go. So maybe, Aiaze, it will be helpful. And then the question: faster payment linkages are already able to bring remittance costs down to about 3%. What is the relevance for CBDC in light of the proliferation of such linkages?
Yeah, so that's what I was saying before. It's difference between 3% and 0%
right,
on incoming remittances that represent 30% of your country's GDP is huge. So obviously it all depends on the context, right? But it could really make a difference, particularly for extremely price sensitive segments.
Interesting. There's actually one more interesting question which just came on chat. If the CBDC is distributed by commercial banks in emerging and underdeveloped markets such as Indonesia and African countries, how do you see the mitigation of exploitation of high interest rates and peer group pressure methods? And I think this again, goes back to the same point that, despite all innovation that we are trying to push and make, right, we still see how much dependency in, low income households or individuals have on, informal sources of finance. How they have to kind of, pay off, a higher interest loan to, serve their needs, because financial institutions are not able to serve. Now, how is CBDC really going to create value add for these kind of households, which might be vulnerable to these things?
So you could in many different ways program that money and have more control over that money. And of course, that's not been tested yet. It's all theoretical, but theoretically, you can actually exercise control over it. So, if you're distributing as a central bank money through formal channels, let's say microfinance or even digital lenders, you could actually program that money to be inactive until the interest rate being charged goes below a certain threshold or a certain cap, and then the money becomes active and they can start using it as working capital. In many different ways, you could potentially control the money that's distributed by semi-formal loan sharks and lenders in different ways to be able to actually inactivate that money for them not to be able to use it at the rates that they charge. But that would require you to have the RegTech, SupTech platforms to be able to actually track and monitor that. But you could go to a very fine level of granularity in terms of monitoring different kind of money flows and attaching different types of features to the money that moves around, including expiration time, limits in terms of when it becomes active versus specific set of criteria, etc. There's a whole range of new things that could be explored there.
And because we're talking of central banks and their key role, and when we talk of central bank, by default we're also talking of government in this way. To what extent all of this becomes more of a control mechanism for governments to serve their own purpose, or and what degree kind of it remains in hands of people in terms of how they want to interact with money and how they want to put it to use.
So it will be in the hands of governments. They will be designing it, they will be defining the features, and that will be driving monetary and fiscal policy in many different ways. So it will be in the hands of governments, honestly, and they can design it the way they want. I guess if they decide to build in some user-friendly features in terms of anonymity, which is the same kind of thing you would have with cash, at least for certain levels. If they build in more control and ownership through sort of a token-based approach versus a wallet-based approach, there's many different features that they could actually add in to decide to give a bit more freedom and a bit more control to people. But obviously, they will be able to track and see all the transactions and have access to that information. And then it's for them to decide how they want to use it, how they want to share it, what the rules of the games are going to be, etc. So it's going back to sort of good design practice, hoping that they would do the right thing.
Thank you so much.
I will interject here. Again,
yes.
This is interesting coming in again. First and foremost, a fascinating discussion we have had. I need to thank our two panelists, Aiaze and Jaspreet. It's not over. We have another session later. But before we actually end this whole conversation here, let me just say that this entire masterclass series is part of the global CBDC challenge that is being organized by MAS and a couple of partners as well. And the challenge is ongoing. 15 finalists have been selected, and they are actually producing their products that will be pitched during the Singapore FinTech Festival in November. So look out for all those details. We will be spamming all the various social media sites as the competition progresses. With that, I say good night. And for those I'll see on another channel, I'll see you there. Bye-bye.
Thank you, everyone.
Thanks, everyone. Bye-bye.